A K-shaped recovery isn't just a graph. It's a hidden story of widening fortunes that few see coming. And the first characteristic will surprise even the sharpest economists. Stay tuned to the end for the most telling sign. Imagine two parallel roads that suddenly split, leaving one lane racing ahead while the other stalls. In a K-shaped economy, that split appears as booming sectors, like technology and finance, growing at double-digit rates, while traditional manufacturing or hospitality crawl at near-zero or negative growth. Data from post-pandemic reports show GDP contributions from high-skill services outpacing low-skill industries by a wide margin, widening the output gap. This divergence isn't just a temporary wobble. It reshapes investment flows, labor demand, and even regional development patterns. As capital chases the fast lane, the lagging side struggles to attract funding, creating a feedback loop that deepens the split. Recognizing this early divergence helps analysts flag where policy intervention might be needed to prevent long-term structural damage.
First, the economy begins to polarize into clusters that move in opposite directions, a hallmark of the K-shape. High-margin sectors such as software, e-commerce, and renewable energy experience record hiring, while labor-intensive fields like retail and travel face layoffs. Studies from labor bureaus estimate that employment growth in tech-heavy regions outpaced national averages by as much as 15% during the recovery period. Meanwhile, regions reliant on tourism saw unemployment rates climb, sometimes hovering above 12%. This polarization fuels regional income gaps and reshapes migration trends as workers chase the thriving clusters. The visual contrast, bright, bustling campuses versus quiet, shuttered storefronts, captures the growing economic divide that defines the K-shape.
Second, the widening income inequality becomes starkly visible, turning the K-shape into a socioeconomic portrait. Household surveys indicate that the top 10% of earners saw income gains of roughly 20%, while the bottom 50% experienced stagnation or modest declines. This gap is reflected in consumer spending patterns. Luxury goods sales surged, whereas essential goods purchases grew at a slower pace. Researchers point out that such disparities can dampen aggregate demand, because lower-income households typically spend a higher proportion of their earnings. The growing chasm also pressures policymakers to balance stimulus measures with progressive taxation debates, aiming to prevent long-term social friction. The inequality trend serves as a barometer for how deep the K-shape runs through the fabric of society.
Third, the labor market itself splits into two distinct camps. On one side, remote-friendly, high-skill jobs enjoy flexible arrangements, wage hikes, and abundant openings. On the other, physically present, low-skill positions confront reduced hours, temporary contracts, or outright loss. According to employment reports, remote job postings grew by an estimated 30% year-over-year, while vacancies in hospitality fell by roughly 18%. This bifurcation not only reshapes skill demand but also influences urban planning, as commuter traffic dwindles and suburban areas see new housing demand. The labor split reinforces the K-shape, turning it into a lived experience for workers across the spectrum.
Surprisingly, capital begins to concentrate heavily in the thriving arms of the economy, creating a feedback loop that accentuates the K-shape. Venture capital funding, for instance, reportedly rose by over 40% in sectors like biotech and AI, while traditional manufacturing saw a noticeable dip in new project financing. This shift is evident in stock market indices where tech-heavy indexes outperformed broader benchmarks by double-digit percentages. The concentration of liquidity fuels further innovation in the fast lane, but it also starves the lagging sectors of the resources needed for modernization. Analysts warn that such imbalances could cement the divide, making it harder for the slower-growing parts to catch up without targeted policy measures.
Few people know that governments often respond with divergent policies that unintentionally reinforce the K-shape. Stimulus packages tended to favor large, export-oriented firms, granting tax credits and loan guarantees that boosted already strong sectors. Meanwhile, assistance for small businesses and low-wage workers arrived later and in smaller amounts, according to fiscal analyses. This policy split amplifies the economic fork, as the high-growth side receives a further boost while the low-growth side lags behind. The resulting legislative landscape becomes a patchwork of targeted relief, with long-term implications for structural equity and future resilience.
Hidden in the data is a growing consumer confidence gap that mirrors the K-shape's contours. Surveys indicate that households in high-income brackets reported confidence levels rising to around 80%, while those in lower-income brackets hovered near 45%. This divergence manifests in spending behavior. Luxury and discretionary purchases rebound quickly, whereas essential goods see modest growth. The confidence gap fuels further economic separation, as businesses catering to confident consumers expand, while those serving price-sensitive markets face tighter margins. This psychological split adds another layer to the structural divide, influencing everything from retail foot traffic to real estate development.
Deep beneath the surface, the rate of technology adoption creates a hidden divide that sharpens the K-shape. Companies in the fast lane accelerate automation, AI integration, and digital transformation, reporting productivity gains of up to 25%. In contrast, firms in lagging sectors often lack the capital or expertise to implement similar upgrades, resulting in stagnant or declining output per worker. This technological gap widens the productivity chasm, making it harder for slower sectors to compete even when economic conditions improve. The divide also influences workforce skill requirements, prompting a surge in demand for digital competencies while traditional trade skills see reduced hiring.
Finally, the K-shape paints a vivid map of regional disparities across the country. Metropolitan hubs that host high-tech clusters report unemployment rates below 4%, whereas rural or deindustrialized regions grapple with rates exceeding 10%. Migration patterns show a net inflow of young professionals to the thriving metros, while older populations remain in the slower-growing areas. These geographic shifts affect housing markets, transportation infrastructure, and local tax bases, reinforcing the economic fork at a community level. The regional story underscores how the K-shape isn't just a macroeconomic graph, but a lived reality for towns and cities.
Ultimately, the final characteristic offers a glimmer of hope, emerging signals of convergence that could temper the K-shape. Recent policy proposals aim to channel infrastructure spending toward lagging regions, while education initiatives focus on reskilling workers for high-growth sectors. Early pilot programs in several states have shown modest reductions in the income gap, with targeted grants reportedly lifting small business productivity by 8%. Although still early, these efforts suggest that coordinated action can begin to bridge the divide, turning the sharp K into a softer curve. Watching how these convergence measures unfold will reveal whether the economy can heal its split or remain entrenched in divergence.
We've journeyed through 10 hallmarks of a K-shaped economy, watching how divergent growth, sectoral splits, and policy twists paint a vivid picture of recovery's uneven terrain. Understanding these patterns helps us anticipate where opportunities and risks will emerge next. If you enjoyed this deep dive, hit like and subscribe so you don't miss the next mind-blowing list we release each week. Which characteristic do you think will have the biggest impact on future growth? Let me know in the comments below.